In episodes 5 and 6, we looked at what the price of money would tell us if we could observe it. The thing is, we can't. In this 7th installment of the basics, we're going to examine critical hints that might point us in the right direction. Bond curves. Since there isn't a single price of money that we could just look up on the internet like we could for a stock, we'll have to broaden our search to focus on areas where changes in monetary conditions would leave behind fingerprints and other clues for us to follow. This is the black hole analogy for the Eurodollar system. We can't see what happens inside the Eurodollar shadow, but we can work out what must be going on from how the rest of the interconnected system is pushed around in response to conditions inside it. Various financial market indications that are being directly and heavily influenced by what's in the center. One of the best of those is the bond curve, but we already have a big problem with that before we even begin trying to track its movements and decipher its signals. And that problem is mainstream economics. Economics teaches us that the central bank is at the center of the monetary universe. Well, we know that's not true. By falsely positioning one of these institutions right smack in the middle of everything, that has the effect of forcing us to look at all the data from its perspective, as if everything that happens is happening because that's the way some central banker wants it. And that's true of how we're supposed to look at bond curves. According to the way in which this worldview is constructed, everything in it, starting with interest rates, must be derived from one single interest rate under full and direct control of the central bank. We must believe all market behavior is dictated by its rate policy. Therefore, interest rates themselves are completely dependent on it. Economics had itself become so invested in the central bank's centric model, practitioners had come to presume a mechanical, even mathematical relationship directly linking institutional policy targets with the entire rest of the financial world. Alan Greenspan, the former Federal Reserve chairman most associated with this control methodology, he testified before Congress alleging that even the U.S. Treasury yield curve, for example, could be easily deconstructed as a series of one-year forwards which begins from the front and largely ends with his very own input as top policymaker. Should he decide to raise his policy target, Greenspan told Congress that all the rest of the interest rates along the curve should predictably, neatly fall right in line with his target. That's how powerful central bankers are considered to be, and how easy it was, at least how easy it was supposed to have been, to control first the yield curve and then all of the banking system before seamlessly manipulating the entire economy from just one simple means of manipulation. A single input along just the front causes a chain of reflexive reactions all down the line. From just a single hike, we're to accept the whole curve shifts up in near enough unison to project the unquestionable authority purported in the central bank-centered model. But how would that work? Set aside for a moment that Greenspan was testifying in front of the U.S. Congress at that time because it wasn't working. How could a yield curve even behave as a series of one-year forwards? After all, the Fed doesn't directly control the first of these forwards either. Though again, mainstream economics treats everything as uncomplicated and smooth, simple anyway. But as we take a closer look at what really happens in these small financial spaces, already you see how the story gets complicated real quick. What the Fed actually offers is a competing return for those in the system who have cash to use in some fashion. Anyone who is seeking merely a short-run, relatively safe place to lend their cash might opt for something unsecured like Fed funds, secured such as repo or treasury bills, or if a better return than any of those, they could choose one of the Fed's alternatives. Though there's more going on, you can see where the narrative comes from, because by being a close substitute for these alternatives, the Fed can heavily influence other money market rates. If the repo rate, for example, falls too low relative to what the Fed's offering, then cash should move on from repo markets to the Fed because of the higher return, thereby pushing repo rates back closer to the central bank target. Economics then assumes it works just the same way down through the rest of the curve, with only one, though highly important, wrinkle. Short-term money opportunities like those offered by the Fed are not quite direct substitutes for, say, buying and holding a 2-year U.S. Treasury. Both are considered free from credit risk, but a lot of other things might happen in 2 years' time if you were to go that route. Therefore, the market must offer an additional return over and above the short-term money rate to compensate an investor for lending money for a 2-year period. Economists call this a term premium. The rest of the yield curve is thought to operate the same way from there, where someone contemplating buying a treasury and holding it for 3 years would need an even higher return, an additional term premium than when purchasing a 2-year instrument. So the further out in time you might wish to go, the farther down the yield curve, the more of a term premium or series of higher term premiums you require to buy and hold those longer term instruments, all building up from the front policy rate set by our central bank. And when you stack those term premiums up, it keeps the yield curve upward sloping, appearing to be a series of 1-year forwards. And as long as the term premium between each forward remains constant, then all the central bank would have to do is raise or lower the front end, and the whole rest will just take care of itself, falling precisely in line, and in a way that just so happens to very conveniently fit into all their econometric models. In practice, though, as you might already guess, it doesn't quite work so easily. Imagine instead that you were thinking about buying a 2-year treasury. You're going to start making your decision by considering short-term substitutes. That much economics gets right. But if you think the central bank is going to raise rates in the near future, you would be less willing to buy the 2-year if you can get a better return on short-term money rates at points during those 2 years. Or if you think the Fed will lower its rates, then maybe the 2-year looks better right now. But that's not the only factor you will be considering. If the economy is truly booming, for instance, then you might find much better returns than lending your money into especially a booming economy, since that booming economy offers better investments well in excess of owning a safe and liquid U.S. Treasury that wouldn't be all that much more of a risk. As a result, we expect that yields on safe and liquid assets would have to compete with real economic opportunities, especially the further away from the short end of the curve you go. The farther out into the future you stretch your investment horizon, the more you focus on fundamentals like a booming economy and invest according to those perceptions. The same is also true for not so booming times. If you believe the 5-year or longer time horizon that things are not likely to go so well, you'd be more willing to own a safe and liquid asset even if its return might be less than what you could currently get from short-term opportunities. This difference is even more pronounced when your view of the intermediate or longer run future contrasts substantially from whichever central bank setting the front end target. The more trouble you perceive, including monetary disruptions, maybe some difficulties in banking and credit, the less you'll factor the current levels for short-term money and policy rates. You'll buy the safety anyway while you can, then hunker down and wait for the downside to happen, completely satisfied in being able to easily ride out that future storm whenever it might materialize. Looking at this behavior from the economic central bank-centered worldview, it doesn't make much sense. When more investors look to put their money into the booming real economy, they force safety to compete and drive up medium and especially longer-term treasury or government bond rates. Is that a higher term premium as economics pictures? It doesn't make sense because a higher term premium implies a riskier situation where investors are demanding more of a return to invest in longer run safe opportunities. In this case, they're just pursuing better prospects outside the narrow financial space of government bonds. This is exactly what Knut Wicksell and Irving Fisher described well over a century ago. These aren't term premiums. They are growth and inflation expectations, potentially big positives. When the economy is booming, growth expectations go up so that the desire to hold safe and liquid assets goes down, driving those yields up. When the economy looks more questionable, maybe likely a recession or worse with banking and monetary disruptions, is that a negative term premium? A negative term premium implies, well, nonsense. As if investors are willing to be compensated less for tying their money up for a longer period of time. That's true in a sense, though, not at all for that explanation, instead for other fundamental reasons. Rather than negative term premiums, the market is perceiving monetary and economic trouble, therefore falling government bond yields on higher demand for safety in the future. That is in every way consistent with falling growth and inflation expectations, not some negative term premium. And should yields on safe and liquid instruments remain low for a prolonged period of time, it isn't because of those either. Fundamental perceptions of growth and inflation expectations as they might impact the demand for safety and liquidity. History only cautions to look at especially longer dated bond yields as they quite naturally appear to be, without any need to make up something else to explain how they might be acting independently. The lower long-term interest rates might go, especially in relation to short-term rates, the more straightforward the signal. Because of that and the fundamentals behind it, this seemingly upside-down curve condition will exert a powerful pull on shorter-term rates too. The more caution is priced into the back end, the more that fundamental gravity will impact front-end maturities, despite whatever central bank rates might be. Greenspan was right about that one thing, if only that one thing. The Fed's short-term policy rate does have an influence on yields up and down the curve. The problem is that he was wrong in believing that was the only influence, or even the most important one. Central bank policy targets are only a place to start. Yes, the Fed sets the rate at the very front. Sure, those maturities closest to it will have to respect it the most. But the farther away you go in this impossibly deep and complicated money and financial world, the greater the possibilities from there. Yield curves are not a series of one-year forwards set dependently by rigid regular term premiums. Those term premiums are just made up by economists to maintain the assertion and the illusion the whole world depends entirely on central banks and their procedures. Once you realize how the Eurodollar black hole is actually exerting the most gravity on the yield curve, along with everything else in the financial system and the economy, not only will the curve's independent behavior make so much more sense, you'll also benefit from all of its useful information and what it is telling the rest of the world about hidden shadow money, so often distorting it. That's what we really want to know anyway, not the central bank astrology. And there are other curves too, which, like bond curves, offer similar style of information from different angles. Or, if you like, how the effects of Eurodollar are impacting financial objects traveling in slightly different orbits. Here in episode 8 of the Basics, we're going to go from basics of bond curves to now money curves. If the Eurodollar is a black hole, a monstrous shadow sitting in the center of the monetary world, we have to get to know how it affects whatever it is we can observe. In Eurodollar University's The Basics episode 7, we looked into the fundamentals guiding bond curves as one way of being able to interpret them for what those might tell us about conditions in the shadows. The uses and properties of the instruments making up money curves might be different from bonds and perhaps unfamiliar to many people, but here in episode 8 we can take the same general set of guidelines we developed for financial curves and apply them here anyway. Starting where we did with bond curves, our biggest problem is economics, meaning again economists. Their view of financial instruments, either individually or aggregated as in a money curve, is skewed by their own assumptions developed from a lack of familiarity and appreciation for the Eurodollar's world. When we talk about money curves, we mean financial instruments tied to interest rates on money. We could also classify them as forward rate curves, since their usefulness comes from betting on where money rates might be at various points in the future. These are derivatives like Eurodollar futures, contracts whose chief use is to hedge against various financial risks. Should market participants become increasingly worried about the potential for something big, they'll hedge using these contracts, and if enough do the same, it will create a noticeable distortion in the money curve. Should that distortion not align with central bank forecasts or especially its policies, as was happening throughout 2007 leading up to the great monetary crisis, the first global dollar shortage, policymakers just outright dismiss the signal as nothing more than hedging, therefore depriving the public of useful, if contradictory, information. But we're getting ahead of ourselves here. First off, what are Eurodollar futures contracts? Since the term Eurodollar is right in the name, we already know it must have something to do with the Eurodollar system, and that it must be related to a money interest rate. And those participating in this marketplace are not the average retail investor. These are large institutions with huge portfolios, the very participants within the Eurodollar system itself. Eurodollar futures are derivative contracts that pay based on some benchmark Eurodollar rate at various points in the future. Eurodollar means offshore, and the benchmark offshore dollar rate, at least up until June 2023, was LIBOR, and specifically 3-month LIBOR. This was the main interbank rate for borrowing and lending on an unsecured basis around the Eurodollar world. Now we're going to focus on Eurodollar futures in this episode because of its long-standing history. Even though the last 3-month LIBOR fix was set on June 30th, 2023, turning over decades of financial history to term SOFR. The final trades in Eurodollar futures were undertaken at the CME in April 2023. Now, term SOFR futures, those are structured somewhat differently from Eurodollar futures, and the underlying benchmark interest rate is a domestic secured money rate. But those key differences aside, in broad terms, we interpret the performance of both Eurodollar futures and term SOFR futures in basically the same ways. Going back to Eurodollar futures, the contract specified paying out based on what 3-month LIBOR would have been at the contract expiration. That means buyers and writers have enormous incentives to uncover all the relevant factors which are most likely to affect 3-month LIBOR from the time the contract is bought or written until that future maturity. Now, we don't need to go into depth on all the contract specification here in the Basics series, but what you should understand is the contract price methodology. The price is simply 100 minus the 3-month LIBOR rate expressed in percentage points. So if 3-month LIBOR at maturity happens to be 2.55%, the final contract price will be 100 minus 2.55 or 97.45. All Eurodollar and term SOFR futures contract prices are stated in the same fashion. So the price gives us a sense of what markets are thinking in terms of forward rates. But we also need to bear in mind, and we always need to bear in mind, that number is not a literal guess, just a start upon which to base more sophisticated analysis. In this sense, those like Bill Dudley from the FOMC back in 2007, they were correct not to take Eurodollar or SOFR futures literally. A contract price of 97.45 does not mean the market is predicting exactly 2.55% 3-month LIBOR on the date of expiration. Instead, there is a variety of probabilities that could lead to something in that neighborhood. It is more like a median, but really just a starting point for evaluating complex prospects. So let's imagine we own a risky fixed income security. Something like a junk corporate bond. It could be a tranche of a securitized SIV, a mortgage bond, whatever. Owning such an asset means being subject to various financial risks. One of the biggest risks is inflation. To protect against the possibility, you could sell or write a Eurodollar futures contract today, which would fall in value if or when inflation picks up. That's because as inflation might rise over the period of holding the futures contract, interest rates overall would go up. And the reason they go up is higher nominal returns becoming widely available everywhere. And we cover this relationship in Basics number 7, as well as in the Wixel series in the Eurodollar University membership site. Conversely, if you become more concerned about credit risk for your junk bond, you could buy a Eurodollar futures contract. Credit risk generally rises during recessionary periods in the economy, and during recessionary periods, interest rates have a very strong downward bias. By purchasing a Eurodollar futures contract today at a higher futures price, that contract will pay off should rates ultimately go lower. And the lower they go, the more it looks like all interest rates move down, the more valuable the contract. And this was the exact scenario the FOMC was debating in the middle of 2007. The question is why authorities would be so quick to dismiss market hedging using this money curve. And the answer starts with the assumptions about the Federal Reserve itself. Since these are money curves tied to short-term money rates like 3-month LIBOR or SOFR, central bankers start out by assuming those rates will only ever follow the future path they themselves set out. Because the Fed or any central bank offers competing short-term investment alternatives for money, the thinking goes that markets will only consider what the Fed or any central bank will be doing in the future. To an extent, that's true, at least for the shortest term contracts. The future price of those will be very, very heavily influenced by the likeliest route for central bank policy rates. But the farther into the future, meaning the farther out on the money curve you go, that influence does begin to fade. Beyond a certain point, the market begins to favor other possible factors which might determine the future level of money rates, especially if those same features are not being taken as seriously by central bankers in setting their calculations and policies. And if the market believes those other factors will ultimately matter more, then the curve will begin to take on a different shape from what policymakers might be expecting, again, as in 2007. Now, one potential deviation comes from inflation. If you and a whole bunch of others begin to expect or even experience higher levels of inflation than policymakers appear to appreciate, together the cumulative hedging would influence the market starting further down the curve. The hedging activity would push down the price of down the curve contracts as more seek protection from inflation by taking advantage today of what would likely become higher interest rates in the future that are thought more likely to go above the central bank's forecast policy. On the flip side, if financial market participants begin to suspect a greater possibility of recession or a major liquidity event, they'll follow the same general idea, though going in the opposite direction. They're not going to be hedging too heavily in the front contracts either, since at first those still remain mostly determined by central bank policy expectations. Yet if this contrary view is strong enough, hedge seekers will find the right place on the curve where central bank policy influence fades and other more fundamental factors could really start to impact trading conditions if it all unfolds as feared. But because even these farther out contracts can end up deviating from the approved official forecast for interest rates, it's more than enough for policymakers to simply dismiss it as nothing more than hedging, rather than admit there might be something wrong with their own assessments. Now, when we zoom in, we can see exactly why it is a mistake to be so flippant. For every individual trader who might want to hedge their perceived credit or liquidity risk using something like Eurodollar futures, there's an entire marketplace to take the other side. And as long as perceptions are balanced, then the market price of the contract isn't going to stray far from the accepted path. But as observation and interpretations of conditions and future risks might begin to change, the balance can really start to shift. As more market participants might seek to hedge in the same way, there would be left far fewer in the marketplace willing to take the other side of the hedge because they are no longer as confident in seeing everything work out as in the central bank path. As one direct consequence, the market price of the futures contract or contracts starts to deviate more and more as the weight of that shifting balance favors the hedging. The outer curve could even begin to noticeably flatten, which, like any bond curve, is a powerful signal. Should current conditions in the economy or the monetary system then move in the direction the hedgers are worried about, the balance in the futures contracts would continue to tip more strongly in their favor, further distorting the overall curve to the point it might actually invert. And it takes a tremendous imbalance like this to get any curve, let alone one so very deep and liquid like Eurodollar or SOFR futures, to completely upset it, even if that happens initially farther outside the front end of the curve. And in one final escalation, should the imbalance then more and more be validated by developments as they unfold, the distortion of inversion could even go so far as to move to the front. When that happens, it is an enormously powerful signal to where fewer in the marketplace are willing to take the side of the central bank, even in the short run, where central bank policies normally dominate unopposed. In all these various cases, why wouldn't you pay close attention to these markets? It may be nothing more than hedging, but if the entire marketplace starts to hedge in exactly the same way, and so few are willing to bet against it, that's an incredibly powerful, incredibly useful information that's conveniently displayed in what really is a straightforward manner. At that point, if the whole marketplace is so out of whack, why wouldn't you want to know what it is that so many in it are worried about? So in thinking about these curve shapes and changes in them, we simply start with the upward sloping curve, one that is more consistent with official forecasts and sentiments. Should the marketplace grow more concerned about the inflation side of risk, for example, those concerns, if expressed widely enough, will actually change the shape of the curve, making it steeper and sending us a powerful signal about how serious those inflation risks are being taken. The same is true should participants seek protection from rising credit risks, rising liquidity risks, or all the potential ingredients for deflation. The first result will be a distinct flattening of the curve. If that continues to where deflation risks keep growing and more in the market believe they're rising in real, the curve will shift beyond just flattening to become inverted. As that condition gets more serious to the point so many in the market are seeking protection from it, the market imbalance becomes so extreme, the inversion will spread forward into the front contracts to the point the urge and need to hedge displaces what should be the unchallenged assertion of central bank policies. That's when you really know something big is up. But because that would contradict the basis of those central bank policies, central bankers claim we should just all ignore it as nothing more than hedging. Well, it is hedging, but when it completely rights the curves, it is far from nothing. These distorted curve shapes are deeply fundamental and sometimes retching expressions of those inside the Eurodollar system. While we may not have Eurodollar futures anymore as of the middle of 2023, as long as we still have access to some money and forward rate curves, we have a window into the shadow system and its black hole. Together with other curves and indications, we don't have to be left in the dark. And in our next episode of this series, we will explore the basics of some of those other indications too. Now, Basics 7 and Basics number 8 are just the tip of the iceberg here at Eurodollar University in our memberships. Obviously, there are 6 more episodes preceding those, and there's a ton more content on top of everything. We've got various series going into background details of the Eurodollar system and how it operates. I'm putting together a new one right now, a new series called Let It Flow, about why circulation of money is far more important than money supply. We've got presentations, we've got questions and answers, we've got a resource library, tons of stuff in the Eurodollar University membership. And in addition to the memberships, there are also research subscriptions, including the daily deep dive analysis, where every day I dive deep into all of the current topics that are going around the Eurodollar system, the macroeconomy, and get into them from our unique Eurodollar perspective. We also have a daily briefing. Every day we get into what's going on in the world and I give you a little bit of an interpretation about what it means. And together we have a package, a Christmas sale the deep dive analysis, the daily briefing, and the membership all together at one incredibly low price. There's an enormous amount of content available already at Eurodollar University, and there's a ton more still to come. Plus the research subscriptions. It's a pretty good, huge value here. So again, thank you very much for sticking through the basics videos number 7 and 8. Merry Christmas to all of you. Happy New Year. And until next time, take care.